Okay, ladies and gentlemen, welcome in all you trader nerds. Hello, nerds, and hello to my wonderful little students at the University of West Georgia. Go Wolves. I'm getting used to going Wolves and going West and all that kind of stuff, but you guys have been a delight so far. So great to have everybody in here, and it's good that everybody is so excited. Now, Emily the other day, she's had sold some puts in several different things, and she was up like $222, which is really, really cool. So make sure that you guys do that same thing that she did. I want you to be selling 5, 6, 7 day, 8 day, 10 day puts in stocks that you like. I like the stock. I want those stocks. I want you to sell puts, sell them at 20 or 30 delta, which means a 20 or 30% probability being in the money. Fill that account up, y'all. I want y'all to see if y'all can make some money. And then it would be kind of cool to see who makes the most money in their account by the end of the semester. Now, wouldn't that be cool? Huh? What if we said whoever makes the most money in the account like gets an automatic A in the class? Well, that wouldn't be good because everybody's going to make an A in this class. But you see what I'm saying? It'd be fun to just have bragging rights like, yo, man, I made the most money in the account. And if you guys think that direction, you can buy calls and you can buy puts on stocks. You would buy a put on a stock if it was what? Someone tell me, one of my students here. Can some of you tell me, would you buy a put if it's going down or up? If you think you want the stock to go down, would you buy a put or would you buy a call?
But it's going down.
You would, you kind of broke up there, but yeah, buy a put. You'd buy a put if you think the stock's going down, and you would buy a call if you thought the stock's going up. Now, the reason I don't buy puts or calls mostly is because it's a losing proposition. Remember, you have unlimited profit potential, but you have a low probability of profit. Now, if you are you got a crystal ball and you knew that a stock was going to explode higher, then you would certainly go, I'm going to buy a call, and you'd be smart to do that, right? But the problem is none of us, I don't think, maybe Cactus Ninja here is a soothsayer and can see the future. But if you can see the future, that's exactly what you do. But since we can't, we have to be more traditional and limit our profitability for a higher probability of success. That's all it's about, y'all. So I'm going to go through a little bit of portfolio management in a portfolio, since that's what this class is about. And then I want to start sharing my trading plan with you all. And I will update this document into the, oh God, what do y'all call it? The den. What's the thing called? Course den or den, wolf den, whatever it is. I'll update it in there so that you guys can have the trading plan. But first of all, let's do what we would normally do, and let's look at the market. Okay, you guys need to get in the habit of looking at the market. And I have the E-minis here. And so the E-minis, y'all, are up 0.86% today. Wow. Waka, 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 waka. So that's really good. So the markets are up after a day yesterday when the markets were down like 2% at one time, or a little bit over 2%. And now they're coming back. So markets are coming back. It was really just based on some Fed stuff yesterday and what Jay Powell was saying, blah, blah, blah. We don't care what Jay Powell says. He's irrelevant to what we do. We just go with the probabilities. That's what we do. So let's see how many people in Wall Street are trading today. We got 4,257 contracts that are traded every 2 minutes. Market's up 0.88%. This was the overnight high. You can see we've taken that out. Now, we were higher, but we're going high again. VIX, which is the fear index, is at 13.91. Historically, that is very low. I think they said that the average VIX is between 17 or 18. So we've got a VIX, a fear index of 13.91. So nobody is scared in the market. This is bulls and bulls away, baby. We are going. We're going to look at a little chart that I call the big green monster to see what it looks like. And there she is, Sally. We have the big green monster. We went down. Guess where? We went down to the 50% line with no surprise that this was a level of support. It was also for the 200-day moving average was And we popped on up from there. So that was kind of cool. Back to the point of control. And where are we going, baby? Well, I can tell you we're probably going up to this point, the 49.34, and we are going for the 49.66. It is just a matter of time. And we will someday soon take out the 5,000, ladies and gentlemen. I don't see the brakes stopping on this market. We are out of control. Now, with that being said, interestingly enough, has anybody noticed in your portfolios that we're losing money today? And I didn't know why. That's kind of strange, right? We're losing money. I didn't know it's probably because VIX was elevated yesterday, but we'll see how we're doing
Your
today.
bill went out. The bill.
Oh, that's exactly it. Thank you, Victor. So Victor's reminding us that Bill went ex-dividend, and when it went ex-dividend, it goes down. So that's exactly why our accounts are down. Thank you. And it's just momentarily going down. I forgot why. That's exactly right, Victor. Thank you, Victor.
Bobby, isn't it time for a new big green monster?
It is time for a big green monster. Do you think that's too much to show our little West Georgia students or not? You think they can handle it?
I don't know.
I don't know. I don't know about that. Hal, let me think about that. That may be too much.
Tomorrow.
Yeah, we'll do it tomorrow. Or we may let them go in a little bit and then we'll do it. That may be too much for them to handle right now. I don't know. I mean, they're pretty resilient. But watch this too, y'all. Look at this. It was amazing too. Look where it came down as an area of support on our linear regression chart. Now, it could have went down farther. I'm not saying that, but it is interesting when you look at these things over and over. The linear regression chart clearly shows we're in a bull market. And it was interesting that this was an area of support right on the midline there. So it's kind of cool. We can see interaction on both sides, but it was cool that we saw area of support there. Support is below, resistance is above, y'all. So you see sometimes this is an area of resistance when it pops this little head up. Sometimes it's an area of support when it comes down. It supports the price. So we look at those lines as well. Okay, let's see how our little account's doing today. So if I can find out how to figure out the net lick on the account, this one that we've been doing, 463,642. 463,642. Let's put it in to our spreadsheet, 463,462. So we're, hey, 463,462. That's not too bad, y'all. We're down $1,080. Dagnabbit. That's not too bad though, considering that is because the price of Bill went down. So we finished the year up about, I don't know, that was probably down a little bit yesterday, but we're probably up 1% on the year, which is really good. This account's not fully built out yet, and that's one of the things that we'll be doing today is filling this account out. So let's now go and look at our Greeks and ratios. So my West Georgia students, young people, you guys, when you drive a car, there are three things that you should look at. Number one is how fast you're going. That's what our deltas tell us. Our SPY weighted deltas tell us how fast we're going or slow we're going. Then you look at your fuel tank. Our fuel tank is filled with a fuel called theta. And theta is the fuel that keeps our tanks going. And the third thing you look at is the tachometer. And the tachometer tells you how the engine's revving up, and it's revving up too hot or too high, the engine gets hot. So that's our buying power usage. Remember, buying power is the amount of collateral that we put up to put these trades on, right? So we got to monitor these things. So let's go look at our little positions and see how much we're using. So this is the account we're looking at. Our deltas are 336. Remember, that means that we have the equivalent of 336 shares of SPY. That's exactly what that means. And it means that because this number is positive, it means we are bullish, baby. Yes, we are. We are bullish on the market. This is America, baby. So we have deltas of 339. Let's put it in our pipe and smoke it. 339. Then let's go to our theta, which is the fuel that we put into this little thing, and I'll explain more about theta. The theta in this account is 393. I said, my gosh, the theta is, where'd it go? Here it is, 393 in this account. So let's go put that in. Just make sure you know where to find it. And let's do it here, 393. So all things equal, ladies and gentlemen, we should make $393 a day from the decay of options. Remember the Apple illustration I gave you. If we sell Apple, so basically we have sold apples for $1, that thing's going to decay. And each day we have $393 chipping away at the options that we have sold, so that when we ultimately buy them back, it should be going up or going down by this amount per day. So this is the amount of profit that we're making per day, which is kind of cool to give you an estimate of what you should be doing. All right. Then we put in the VIX factor, which is 13 today, 13 to 14. And our buying power usage is over here. Now, we can't use this, though, because this includes the amount of bill that we have. What is bill? Bill is an ETF, exchange traded fund, just like SPY is. SPY is an ETF. PLT is an ETF, right? So it's an exchange traded fund that holds 1 to 3 month treasury bills. And because it's not part of our regular program, we count that buying power separately from our options trades, because we're not trading options on bill. We're just buying or selling the shares of it. So let's look at our positions. Bill is taking up $309,000 worth of capital. Our E-mini S&P 500 futures are only taking up $163,980. So let's say it's $164,000 of capital. Okay, 164,000. So we're using 35% of our capital in our options positions. Now, remember that we can use my plan. Well, you probably don't remember because you guys hadn't seen the plan yet. I'll introduce you to it. I can use up to 50% buying power as long as I want to, and certain conditions are met, which I won't go into at this amount, but I am now in a position where I kind of like to go 50%. And remember from the sizing calculator that today is day 14 or week 14. And by now we should have 17 of these 112 positions. 17 of these little jokers. Where's the right color? There it is. How many do we actually have? My spreadsheet tells me that old sweet Bobby, instead of having 17, it says, Bobby, 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 you've only got 13 positions. So what does that mean? I have not been putting on enough trades. So I will put on 2 contracts today of this thing. That'll give me 15 positions. Okay. So here's where I want to go into a little bit of my trading plan, so you'll kind of know what we're doing. Okay. And I hate to read to you like you're a 5-year-old, but here's my trading plan. And all of you ladies and gentlemen will have a copy of my trading plan. You will also have, and if you are a portfolio manager, you should have a trading plan or an investment plan. Mine is 7 pages long. And it tells me everything that I can do, not do. Look at this. And you'll read it and you'll go, what the crap is he talking about? It makes no sense at all. So I want to go through this a little bit quickly. So here's my trading plan. You should have an objective in your trading plan. This is like you having a written business plan. And the business plan says that I strive to quantitatively extract profits. It doesn't say that I technically extract profits like the technicians do using charts. No, it doesn't say that I use fundamental analysis and news and watch CNBC to make or your mama likes Amazon because she's, spending all your inheritance on Amazon and you think you want to buy Amazon. No, I use quantitative data in order to extract profits from the financial markets, and it tells the actual stocks or underlyings that I can use. I can use the micro E-mini S&P futures, which is /MES is the symbol, or I can use something that's 10 sizes bigger than this. It's the same thing. It's quoted the same thing. It's just 10 sizes bigger or 10 times bigger. The E-mini S&P futures, which is /ES, which is what you will see me trade today. I'm going for a minimum 20% annual return, baby. Yes, hallelujah, and praise the Lord. That's what we're going for. We want 20%. We're looking for 20%. Now, if you can do 20%, ladies and gentlemen, you are among the greatest hedge fund managers on the planet, right? I mean, 20% is unheard of. Bernie Madoff, who was a fraud and a fake, only gave his investors a fake, because he wasn't trading anything, a 10 to 12% per year. And they were happy as little pigs at slop. So if we could do 20%, that would be good. All of my trades are entered in an Excel spreadsheet, and the spreadsheet monitors my overall portfolio metrics. Now, the trading strategy is composed of two primary components. You already know what a naked put is. When you sell a put in Amazon, it is naked if you're just selling the puts. That means it doesn't have any protection down below it. It is naked as a jaybird running with its little butt flying in the air down Maple Street in front of the university. It is naked, baby. And that means that you could lose big time if the stock goes to zero. And we use a little thing called a put debit spread, and I'll show you that in a little bit. Now, remember, we talked about that your portfolio. Now, these are my metrics. Doesn't mean it has to be your metrics, but I look at three different things. Delta. Delta is the speedometer. That's your speed. That's what delta is. How fast am I going? Right? And we saw that I had 300 or so. And my delta, which is how fast I go, is SPY beta weighted. Remember, it basically shows you the equivalent shares of SPY that you own in your portfolio, and it should not exceed 0.0015 times your portfolio's net liquidation value. When you hear me say net lick is short for net liquidation value. All this is the total value of your account. So let's say that Mama's got $100,000 in her account, and she's got a trading account with $100,000. Well, what does that mean? That means that Mama's net lick is $100,000. It looks like, doesn't it? $100,000. So I don't want your deltas to be more than 0.0015 times your net lick. So what's 100,000 times 0.0015? It's 150. So I don't want your deltas to be plus or minus more than 150 deltas. Deltas. Okay. Now, in that account, it's 400 and something thousand. So we could be much more. We could be what, 600 deltas or so, plus or minus, and still be fine. So in other words, my account may look bullish, but this tells me that my account is delta neutral. I want my account to not be too bullish. I don't want it to be too bearish. I kind of want it to be just a little bit neutral. And I have defined neutrality as a delta of 0.0015 toward times the portfolio's net liquidation value. Key questions. Speedometer. All right. So we got speedometer. And how the heck do you do this thing? The next thing we have is a little thing called theta. And theta, let's get another color. Theta, how about green? Theta is your fuel gauge. All right. So theta is your fuel upon which our portfolio runs. A primary goal is to maintain a minimum theta of 0.001 times your account value. So on a $100,000 account, that would be 100. I want to maintain 100 theta every day in a $100,000 account. $200,000 account, it'll be $200. And what does that mean? It means theoretically, all things being equal, and normally all things are not equal, it means that we should make $100 a count if you've got $100 of theta. It should mean you make $200 a day if you got $200 of theta. Now, I allow myself to take more risk and to sell more options if the VIX, you need to know this, VIX is the fear index. Remember, we said that the historical average is around 17 or 18. Right now, we've got a VIX of almost 14. So it's very low. And when volatility is low, you take less risk. When volatility goes up, you can use more risk or sell more options. When it's really high, above 40, man, you can use up to, up to 0.005 times your account instead of 0.001. Theta is what drives an option seller's portfolio. It is a beautiful, beautiful, beautiful thing. Think of it as the amount of the apple that rots every day that goes into your account, because when you buy that apple back that someone's taken a bite out of or that's rotten, you're going to pay less for it because it's been bitten out of or it's rotten, and you're going to make money because you're going to pay less than what you sold that option for. That's what we want to happen. So that's your fuel gauge. Theta, theta, theta. You guys at West Georgia should actually start a fraternity or a sorority that's called Delta Theta Theta. Delta Theta Theta. If there's not one, y'all should start one. Delta Theta Delta. Something like that, because these are really, really good things. Delta's good, theta's good. Now, the third thing is your little tachometer. How much little power are we using in our account? Buying power ensures the overall position sizing is not too large and the portfolio is not taking excessive risk. It is permissible to run the portfolio at approximately 50% buying power if the underlying price is above its 200 daily simple moving average. In other words, if you were to take the 200 previous days and take the average of that, that's your moving average. So while the price of the stock may be doing this, up, 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 down, down, up, your moving average is something that's kind of smooth. It takes the last 200 prices and keeps up with them of whether the whole thing is going down or up. So I have basically said that it's permissible to use 50% buying power if the underlying price or the price of the stock that I trade is above its 200 simple moving average. And you can actually see these on the chart. So what's this? I trade the E-minis. And I have set up a daily, this is a daily chart. So this is the price of the E-minis and what it did on September, whatever the date this is, September the 20th. See over here, the dates change. This is the price that it traded on November the 10th. Everybody see that? So you see that the price goes up and the price goes down, but the 200 moving average keeps up with the last 200 prices, and it makes an average out of it. And so as long as the price, this is the 200 daily moving average, as long as price of the E-minis is above its 200 daily moving average, I have permission to use 50% of my account to buy or to sell options. Woohoo! Let's go back to our little thingamajig. Or alternatively, if you don't want to look at the 200 daily moving average, you could look at the 10-month moving simple average. All right, let's look at that. The 10 monthly moving averages looks at the price of the E-minis on a monthly basis. So this was the price for the month of September of 2020. So you see all of these price things go for a whole month. Wow, look at this. This was back during the COVID crash. See the COVID crash? It went all the way down, it went all the way up, and it settled right here. This is April May, June, July. And this basically keeps up with an average of the last 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months. And each month it adds another month to it and the average change. So the price is either going upward or downward, and the average kind of moves slowly with it. As long as here we are in February, we've got a very small little dot there because we are just on the 1st of February. But as long as price on the monthlies is above its 10-month moving average, I have permission to use 50% buying power. 50% of my portfolio net lick can be used to sell options. And I look at another thing. And the 10 weekly, so this was a daily chart. This was a monthly chart. I also look at the 10-week exponential moving average. Now, what does it mean to the difference between simple and exponential? Simple gives each time frame equal value. So if I'm doing a 200 day, like 200 days ago has as much value as today. They're equally weighted. Exponential gives more preference to the latest time frame. So last week has much more weight than the week before it, and so on and so on. So it looks more at the current weeks and gives it more weight in moving the moving average. So I'll look at the 10-week versus the 20-week exponential moving average. And as long as the 10-week exponential average is above the 20-week exponential moving average, then I am allowed to use 50% of my buying power to sell options. What does that look like? So now let's try and change this chart. Instead of monthly, let's look at the weekly. And here you can see the blue line is the 10-week moving average. See how that goes? And the green line is the 20-week moving average. As long as this 10-week moving average is above the 20-week moving average, and you can see now that it is, I can use 50% of my account to sell options. If this line, let's say we're back here, is below the 20 moving average, then I have to take risk off. Because the fear is, see where it first crossed over here? This is where I would have taken risk off. I would have kept risk off all the way through this. I would still have kept risk off all the way through this. We didn't cross over there. It would have only been at this point, this week, when I would have gone back to using 50% of my account to sell options. So you say, otherwise, what do you do? Not sell options? No, I didn't say that. What I do, buying power will be allocated per the chart below. Okay, so we got another chart to look at. Aha. So if these conditions are not met, the moving averages, the three that I showed you, if these are not met, and the moving averages or the price of the E-minis is below its 200 moving average, then I switch to this. Instead of using 25 or 50% of my net lick value, it depends on how the VIX is. Lower VIX, lower amount of usage. So VIX is low and nobody's scared, I'm scared. Remember Warren Buffett, when everyone's scared, be greedy. When everyone's greedy, be scared. No one's scared here. No one's scared. So I'm a little scared. I'm not going to be greedy when no one's scared. When everyone's scared, when the VIX is above 40, I'm going to be greedy. Volatility equals opportunity. Yes, this portion is still recording. You join late and want to come back to review this? Absolutely, it is. It's being recorded. Because this is a lot, y'all. I know it's a lot. And bless y'all's as little souls. Everybody's going to get an A, so y'all you relax. I want you to learn this so that you can be a portfolio manager. Y'all just relax. It's going to be okay. All right? No detailed test on this. This is just for you to learn. All right. So we got buying power as our tachometer. You know what the fuel is. You know everything. Now, next week, we're going to start getting into the components of the strategy. Right now, you're going to see me trade the strategy without you necessarily knowing what I'm doing. But I'm going to do the same thing every week. So hopefully that you're going to know what I'm doing. So let me go ahead and do it today. All right. I'm trading what is called a 1-1-2 trade. Remember, I told you I needed 17 of them. I've only got 13 of them. So I got to do 2 tranches today. What's a tranche? A tranche is a bucket of position sizes, right? If you normally trade one contract, then doing 2 tranches would be 2 contracts. So I'm doing 2 tranches of what I normally do. So let's go to the little trade tab here and let's just set it up. So what we're going to do is we're going to trade the E-minis in this account. Make sure I'm trading the right account. Yep, that's the right account. So what I do is I go to the trade tab. Now I know you guys are using Thinkorswim. That's fine. You would be using Tasty if they had a paper account. So what I'm doing is, this should look familiar to you. I'm going out in the options chain. Remember the options chain. I'm going out 120 days or closest to 120 days. Just like you and your assignment, I am selling options. Let me clear this out. And I am selling something at the 5 delta, which means the 5% probability of being in the money. See this 5%? See this 5%? 0.05 delta, that's what we refer to as 5 delta. We don't go 0.05 delta, that's 5 delta. Delta and probability of being in the money are an approximation of each other. So we're going to go to the 40-50. And the 1-1-2 trade would ordinarily sell 2 naked puts. But since I'm doing 2 tranches of this, I'm going to sell 4 naked puts, 3, 4. Everyone sees the -4 here. Okay. Now, let's look at this. This has a 99% probability of success. Y'all, I like my odds. I love my odds. It has positive delta. It's giving me $59 a day in theta. What does that mean? Theoretically, it should decay $59 a day and make me profits of $59 a day. My max profit is the amount of credit that I receive. So on these, I'm going to receive $3,150. My max loss is if this thing goes to zero, right? I'd lose $806,000, and they're going to charge me $25,000 worth of collateral for putting up a trade that could lose $806,000. Now, interestingly enough, I don't think I've got enough buying power to put this trade on. Look at this, because it's saying I'm using 99.9% of my buying power. Let's see if I get an error. So let's say that you guys are selling options and you just keep selling options, you keep selling options, and the next thing you know, you can't do it because you're out of buying power. Then you'll get a little thing that says account does not have sufficient buying power for this order, margin check failed. In other words, I'm using 100% buying power. But remember, not really, because we've got all that bill in there. So what I've got to do now is I've got to unload some bill. So let's go trade some bill, get rid of some bill. We've got 3,390 shares. So let's close some of those shares. And let's close 100 shares. Should give me, what do we say, not $10,000? So I'll show you how you just kind of work this out. I really should sell probably 200 shares. Ed will figure it out and tell me exactly how many I should share. All right, so we sold those. So now I've got $18,000 worth of buying power. So we got to sell probably another 100 shares of that.
Bobby, what was the required margin you needed?
Wasn't it 23,000, Ed, or so?
I didn't quite catch that.
Hold on a second. Let me see what it was again. Let me go back to E-minis and see what it was.
You get about 91.50 for every 100 of cash.
Where's my E-minis thing? My 120. Oh, I had it here. Yeah. Here we go. Just still got my order up there. Nope, it didn't do it. It's let's go back. I think it was 23,000. Was that right, y'all? Let me just close another. Let's see.
So 150.
Sell 100. I think I only need 100 more now, though, Ed.
What did you sell? Okay,
I already sold 100.
okay.
So should I sell 50 more?
It's $9,142 of buying power for every 100 you sell.
Yeah. So let's see what 50 does. See if it gives me the 23,000 necessary.
But Bobby, running it at close to 100%, aren't you getting interest charges on your?
Not in an IRA.
Oh, you're in IRA. Sorry.
Yeah. So it's an IRA, right? So there's no interest. And so they would let me know, hey, you got to, close something before they start doing that. So this gives me 23,000. Let me sell about 25 more, y'all, just to make a little bit more room in there. Or I'll tell you what, I think I'll do another
And
50.
you could even do 50 and leave yourself a little
Yeah.
expansion area.
Yeah, let me give me a little bit of room here. Let's sell another 50 shares. There we go. So that should give me 27,000. So that should be enough. So let's go back and put those naked puts in again. /ES is what we're trading. We're going to go down to 120 days. We're going to go to the 5% probability of being in the money, either of these. 1575 to 4050s, 99% probability of profit. We got to bump our quantity up to 4 of these. We're doing 2 tranches. So our max profit is 3150. Review and send. I guess we should show them what it looks like, right? Selling 4 puts. Let's look at the risk curve, risk profile, so you can see what it looks like. Let's let this down. And it's nice and neat and looks like this. This is what it looks like. Current price of the stock is here. Look at this, y'all. If the stock goes up, I make the same amount of money, 3150. Look, the stock goes down. At expiration, I make 3150. Look what happens, though. I start losing if we go down too much too soon. All right, here's my 4 puts. And then look, it's got a break even down here. We talked about break even before. But even if the stock comes all the way down to 40.66, I still make that at expiration at the end of 120 days. I still make my $4,066.50. So they're going to use $25,000 worth of buying power for this. I've got $27,000 worth of buying power left. So this trade should go through without a hitch. And bingo, baby, we are in. Now then, we've got to do the second part of it. And we'll go into more what this is, but this is called a put debit spread. We're actually going to buy a spread. So let's go back to the trade tab. I'll just show you this quickly. And go back to the table. We're in that same 120. I'll go through this fast. We're going to buy the 25 delta or so. I don't buy where I've sold and sell where I buy. I try to buy where I've already bought and sold where I've sold. So I'm going to buy the 4,700. I'm going to sell the 4,600. Now, what does this look like? Let's see what this trade looks like. So let's go to table and analysis and just click those 2. Check this little puppy out. Look at this, y'all. This thing looks nice. Now, I'm buying a spread below where the current price is, and I'm hoping that price goes down so that I start making money. Look at that, y'all. At expiration, I'm going to make $2,120 if price goes down, regardless of how far it goes down. Look at this. Isn't that cool? So this is a little bit of a hedge to the downside to those naked puts that I've sold. So let's go ahead and look at this. The only problem is this particular trade, which is part of the other trade, only has a probability of success of making money of 26%. It has a negative theta, which we don't like as option sellers. But again, this is a hedge. The maximum profit is if price goes down below the entire spread goes into this area. I make max profit. My max loss is what it's going to cost me to buy this thing. And I'm going to buy 2 tranches of this thing. We'll try the 775, see if we get filled. Now, look, they love this because it's a hedge. They're going to credit my buying power. So I've only got $2,600 of buying power. It should add another 2,000 once I get this trade filled. So let's do review and send, and bingo, we are in. And this should go up to 4,600. Boom. All right. that's a lot for you. Some of you have already dropped off and you're going, this ain't for me. I got it. But I just wanted you to know that this is the way that we manage an options portfolio. We put trades on, we take trades off, and we go through the plan. So we will finish going through the plan next week and get you more involved in the actual selling. But in the meantime, I want you to sell, sell, sell. I want you to sell puts, sell puts, sell puts, sell puts, and get your accounts filled up as well. Any questions at all from today? Anybody? Okay, if not, I will see y'all Tuesday and I'll see my trader nerds tomorrow.